the recording is on the way now. Any questions before we begin?
I found the whole business of trading, particularly in that very short time frame. The 1 minute, I missed a lot of entries, and the market just took off, and I never could get in on occasions. But I found it very stressful. I found the chop very stressful. That I could be waiting, and then I'm expecting, and then it doesn't happen, and then I'm waiting, and I'm waiting, and I'm waiting, and then it takes off, and I'm not there. Yeah. And that is okay. You've talked about why you use ticks and not minute charts, because it allows you to see the patterns and to move into the market a lot easier and out. Right. And I then thought, oh, okay, why not? So this is something I've been looking at in the last few days. Why not forget about your minutes and your 5 minutes and just go over to the Renko bars? And so I've gone over to CTrader, and I've got CTrader platform. Yeah. And I've been looking at. As you can see, I kind of favor more currencies than I do indexes.
That's all right.
And I thought, oh, okay, I'm getting nice patterns here, and everything is very clear. And where there's chop, I don't see it. I just wait for patterns to emerge, and then I can step in. Because in using a time frame.
There's a lot of in time frames, and especially is a lot of noise always.
Right, and the patterns are not as clear.
No,
I'm trying to figure out patterns there, and they're not as clear. It's just a comment, yeah.
But the thing is, if you are more like a trader for forex, you will probably have an advantage when you trade on medium to higher time frames, which is like hours, 4 hours, days, because forex doesn't move as nervously as the Nasdaq would, for example, or some tech stocks. So they all have their own rhythm. So you just have to see whether that rhythm fits your life, and how you can organize your life around that. But that's fine, because I got maybe 40% of my students who are trading forex, also other stuff, but they do this on higher time frames, going from a few hours to a few days.
Oh, right. Okay.
And then the trick is, of course, if you get bored sitting, in front of the screen, what I do with them, we build some screeners. So a screener is a tool, or different tools, algorithms, which can find financial instruments which are in conditions where you like to trade them.
All right, okay.
So instead of waiting in front of your screen until your movement comes by and you strike, you actually take a list of whatever, 50, or if you go on longer time frames, can be 500. You let the screener run, and then you get out of 50, you maybe get a list from 25 instruments, which are exactly showing a correction or a breakout or something like that.
Right.
Then you click, you go through them, and you see them, that might be a good one. And then you can enter, or you can put in an alarm or anything, you see. Right. So it's how I started. Okay. The first 3 years of my trading career, I was still working. I had no time to sit in front of the computer during the day. And so I run this, I ran these screeners in the evening.
Yeah.
I just ended my positions and then looked at it the next day.
Right.
So it's another rhythm. Now, the analysis part is exactly the same.
Right.
And whether you want to do this on Renko bars, you want to do this on time charts or whatever, makes no difference.
Right.
Makes no difference. So it's all the same.
Yeah.
And that is something that is more, once we got this part behind us and we talk about the trading plan, we'll do 1 or 2 sessions and I'll show you the possibilities and you decide what you want to do.
Okay.
But it's something that many people, I have to say, swing trading or I would say it position trading is, I think, easier for people to succeed than scalping or fast trading.
Right.
But some people have this feeling that because they are trading on a very short term, that the risk is substantially smaller and that they are more in control.
Right.
This is wrong.
Right.
That's not the case. That's not true. Um, of course, if you, well, it's a little bit like I do. I sit in front of a computer for an hour and a half, and I will do a few trades and then close shop, and that's it. Now that sounds very tempting to many people, but I must say that it's probably one of the most difficult ways of trading because the costs are very high, and you need to be very strong mentally.
Right.
What do you think?
I noticed that with this exercise, I was making, I don't know whether I might have lost a little over the whole of the exercise. I'm not too sure.
Mm-hmm.
But I was making more money for the broker than I was for myself. If I
Yes.
happened to make money, actually, I probably had a plus on pips, but
Mm-hmm.
those pips, those gains that I had monetary on a monetary basis, well, I wasn't getting that. They were going to the broker.
Yeah, it makes no sense.
And that doesn't make sense, right?
No, and also people do not always understand, especially when you start scalping. I think there's only one product which is really suited for that kind of trading, and that's futures.
Right.
Because other stuff is just in a way too expensive. Why? The value isn't high enough in comparison to the commissions you have to pay. That's one problem. And the other is, of course, that you have spreads which are substantially higher. Now you pay these spreads every transaction you do, which makes it, you have to be very careful when you calculate that business model. And people try to do this on CFDs or sometimes on Forex markets. And that is not the best choice. You can do it on tech stocks. You can do it on volatile market indexes, but that's it. I mean,
Okay.
it should, or otherwise, you should have another rhythm. But that's okay, Brian. That's
Yeah. Yeah.
that's okay.
Yeah.
Well, I'll show any other questions about the
Mm,
core things, stuff you've done or anything?
no, but I got a feel there for, okay, found out that I was expending quite a bit of energy.
Yeah.
Um, and I was thinking, well, it's not only a question of cost, but it's also a question of energy. And there
Mhm.
must be an easier way for this. Maybe you're right. With those higher time frames, if I was trying to look at a 1 minute and 5 minute, I was missing it on the 1 minute, I was missing it on the 5 minute, whereas I would have had an entry on a 15 minute, but I'd missed it because I wasn't looking at 15 minutes, I was looking
Yeah.
at 5.
Now there's a lot of, especially in Forex, on 1 minute, 5 minute, it is very, very small, and there's a lot of noise. There's a
Yeah.
lot of noise, and you have to filter through the noise. Okay.
Yeah. Yeah.
Here, what these? So that's 1 minute. You tried on 1 minute here.
Yeah.
See that? All right. Now I just have a quick look. The red line is EMA 8, probably.
Right.
The blue one is 20,
Yes.
and the black one is what? 110, 50? Which one?
No, the 50.
All right. Okay.
But the 50 simple moving average.
Right. Well, I don't have a problem with that. Okay. So you on the left, you said that's my entry candle where you wanted to enter.
On the 5 minute, yeah.
Yeah. Oh, you checked on the 5 minute and then you did an entry on the 1 minute. Is that it?
Well, I had them side by side almost in the split screen, two screens. Yeah.
Because here what you see is it's over the blue line.
Right.
And here it's under.
Right.
So in all fairness, the way I look at this here, if you look at this is the EMA 20. This is over. This is under. That's sideways.
Uh-huh.
No trading.
Okay.
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 So here you got a little bit of the same because the market, well, seems getting under, over, under, over, under, over this blue line. Now, me personally, I would have bought here, would have lost. But anyway,
Okay.
you see, because I stay on the right side of the blue line, which could have gone like this, and then I would have been in here. So, all right,
Right.
can't have them all wrong. But then again, under, over, under. So a potential entry would have been here, for example. Here as well. Here as well. You understand? Because you are staying on one side of the EMA 20.
Yeah.
Because you see, if this is the EMA 20, like this, let's say it's going like this, and I just draw the market now. What you normally have, if you see the EMA line like this, is that you have a market over it, under it, over it, under it. That is sideways. We don't trade that.
Right.
But then you get to a point, well, it goes under like this, and then comes a time when it goes a little bit higher.
Yeah.
You can't know this in advance, so
Right.
you probably you've not entered. But if it comes back then, and it turns again in the vicinity of the EMA 20, that's where you strike.
All right.
Okay?
Right.
But as long as you see this, Brian, you don't trade.
Right.
Because you don't have a trend movement. There's no trend. All right? Okay.
Yep.
So just take that. All right. Now, just as a matter of interest, why did you enter on this candle?
Well, I'm above the 50.
Yeah.
So I'm on the buy side, and I have a separation between my 8 and the 20, and the 8 is stacked on the 20, so it's moving upwards.
Right.
I have a couple of bullish candles there, and I've taken it on the 1 minute, the entry there where I've got an engulfing candle,
Yeah.
and,
And you
and
see the higher,
with
you
my
see the
stop
higher
underneath
low.
the lowest low. Yeah.
Yes, well done. The only thing is, and this is just
Yep, please.
absolutely right what you did here. The only thing is that for me, as long as this level has not been broken, I consider that this market is still in a fair value range.
Yeah.
It could
Right.
stay in here for quite some time.
Right.
So if you want to do this on the safe side and not spend too much money on, let's say, over trading, because you don't know if it's the first move or the second or the seventh move who will actually really press through. You just don't
Sure.
know.
Sure.
It's sometimes better just to wait until it presses through, like here.
Yes.
You wait for it to come back. And when it confirms this new high again, then you buy, because then we consider that this area has been left behind.
Right.
That is a trick. It's just
Okay.
it's just to avoid, because if you enter here, and again, the whole analysis is correct. But if you enter here, you're actually entering here because you think, rightfully so, that it will break out and go higher, which
Right.
probably it here did. So that's all good. The only thing is, Brian, that's the point I'm trying to make. You don't know when it's going to break.
You're
And the
right.
risk that it's not going to break, or that it's only going to break much later, you can't account for that. So it is, in my opinion, safer to wait until at least it breaks or it makes an attempt to break, and that you enter afterwards. The worst that can happen here, Brian, is that it breaks to the upside and that it moves very strongly, and that you're not in the trade.
Right.
In that case, you have to wait for a continuation trade or a correction and enter then again.
Yeah. Yeah. So this is part of it. I'm anticipating, because if you go back to the 5 minute
Right.
chart there, you'll see one big, very long green candle. So
Yeah.
there's an interest there to buy this thing,
Right.
and
No,
it's
no,
just
no,
a question.
absolutely. It's and also you have nice support here in the middle of this candle.
Yeah.
All good. I mean, from that perspective, it's all good. The only point I'm making is with these kind of
Yeah.
moves, in all fairness, they could be hanging around here
Yeah.
for
Yeah.
for a while.
Yeah. That's right. Yeah.
But analysis was definitely okay. So like this. Entry on this candle, I can understand that. That
Yeah.
is on the 8, yeah, that's okay. And that's the entry here. Yeah, stop there, first targeted. Well traded. Yeah, well done. Well done. Yeah, perfect. Yeah, that's good. Yeah, yeah. You even could have gotten in a little bit sooner, but the
Yeah.
trade is good. Yeah,
Yeah. I could have
well
gotten a
done.
little bit sooner. That's true.
So, all right. No, that's well done. Yeah. Okay. Why an entry in this area?
Yeah. It looks
Here.
like looks like it's had a on the 5 minute chart. It's had a bit of a run, and I should have waited for a pullback. I see that now.
Yeah.
Uh,
The problem is if you buy when the price is at a good distance or at a far distance from the exponential moving average 20, theoretically, you're buying this thing too expensively.
Yeah. Yeah. Yeah.
So as you said, it might have been better. And again, this thing has moved upwards. So definitely the buyers are in control. But if we missed this move, this first move, if we missed this impulse move, we must wait for this thing to come back, find his foothold again, and then start again in the original direction. So here, this was not a good time to buy this.
I remember my reason for getting into this one.
Right.
I remember I was thinking, okay, there has not been a pullback to the 20 on the 1 minute.
Mm-hmm.
So if it pulls back to the 20 and goes over the 8 again, jump on it, because this could be one of those ones that kind of goes vertical. It had been pretty straight, and buyers were certainly in control, but it didn't work out.
Mm-hmm.
So that was the first opportunity I got.
There's one thing I just wanted to, how I would again trade this.
Yeah.
Let us say we are in here until here. We don't see this last bar coming down.
Right.
When I see this box or this fair value zone like here,
Right.
and this is the move upwards before, what I will do is I will, let's say it doesn't correct, I will trade this only to the upside. But what I want, Brian, is I want one candle breaking the fair value zone area, for example, until here. This is then my new high. And when it gives me a triad, or it comes back into this area and comes back up and takes out this level again, I'm all over this thing. Then I'm in this, because then this area has definitely been killed, and we start again.
All right. Okay. Mm-hmm.
Let's have a look. You wanted to enter here. I understand the move, but it's a bit late.
Yeah.
Huh? It's a bit late.
Well, the other thing is, I got, you see two green candles.
Right.
One stacked on the other, yeah, and on the chart on the right hand side, that's where I entered at that point there. But on the close of that first candle, I entered, and with the spread, it's taken me up into the middle of the candle ahead, which is built up on top.
Right.
Yeah.
But again, you saw the direction good. You see here very clearly that this is a fair value area, actually.
Yeah.
And you see higher lows. So there's pressure to the upside. Then you often have this, that it dips down one last time and then it goes up. So yeah, this was definitely a good trade. Yeah, it was good. So correct here, you enter on this one. Why on that one, Brian?
Well, I think I was looking at the 1 minute chart. You see that's the close of that candle, of course, on the 5 minute. I wasn't entering on the 5 minute, I'm entering on the 1 minute. And it just happens that it ends up on the 5 minute looking like that, but I didn't enter at the close of the 5 minute.
You got in here.
Yeah, you see there's a bearish one, a bullish one, a bearish one, and it's got pushed back up again.
Yeah, but I think again, what you saw correctly is clearly the pressure going upwards.
Right.
That I understand. The only thing is here, you trade what you think or what you analyze. You don't trade what you see. Trading what you see would be waiting for the confirmation and only then strike.
So where would you have entered that one?
Well, this one, if this is the fair value area,
Yeah,
like this,
yeah,
right?
right.
In my, that's also why I like to trade with these range bars or movement bars, because
Yeah,
it would have probably given me a bar somewhere here, maybe got some hesitation, and then would go up again and I would strike there.
yeah,
Here, of course, you have to wait until this bar, which is far out, which is again, and that is the problem with these breakouts. If you well display them on time charts, you often get these big candles on which it is very difficult to trade.
yeah,
So
that's right. That's right. Yeah, I was hoping, unfortunately, I was able to take my first
right,
half of, I would
first
have
target
taken
hit,
half of it
yeah.
off and hoping then that would continue to run up higher, but it didn't, it took me out.
And okay, the targets, and you do this targets as we discussed. You mirror one part to the upside, and then the other part you let it run.
Yes, that's right.
All
One
right,
centimeter for 1 centimeter, that's the first
good.
target.
Yeah,
And
that's
with the second, I often leave the stop where it is,
right.
just to give it a little bit of space, so that I can move it up afterwards.
Hold on.
I'm not too quick in
No,
moving
that's fine.
the second part up.
I can't seem to make this bigger. Hold on, why is this not working? Hold on. Oh, that's better. So you enter there, here. Hold on, I'll show you. Here, I can see it. You enter here.
Yes, but there should be another part to that. No, that's the 5 minute chart.
Okay.
And the 1 minute chart, I've obviously not brought it in, but
Hold on.
obviously it's the 1 minute that I'm looking
Yeah.
at most of the
Maybe
time.
underneath. No, it's not there.
No, it's not there.
This, in my opinion, is a mistake, because
Yes,
you are trading in a
in a
range.
range. Yeah,
So remember the slide in which I say these are the 5 mistakes that you will see most often. And the first one is trading in the absence of a trend, or
yeah,
even sometimes, but that's rare, where people trade against the trend,
right.
right? But here, there actually is no movement here. This thing just lies there, and
Yeah,
you
sure.
do not have an edge to
Right.
trade in one direction or in the other.
Right.
Hold on. So like this.
Oh, that's it. That's the, is that it? No, it's a 5 minute
It's
as well.
5 minutes.
Okay.
You entered here. Now I can understand this trade. This is good. Well done. Yeah, good. You see, that is a very interesting move always to trade. There's a strong move to the downside here. And then you have these first signs of strength, and then you strike here. Very well. Yeah, that's good. That's
Right.
well done. Yeah. So that's clearly also you see higher lows. See
Yeah.
that?
Yeah,
Well
that's
done.
right.
Yeah,
Yeah.
it's good. Hold on. Make this smaller. Yeah, it's trading on full automatic. Yeah.
All right.
Right.
On the Nasdaq, is it?
Yeah, Nasdaq and still DAX is on them, but the one who is by far giving me the best results is the Nasdaq because it's so volatile and
Right.
really works well. Do I see this correctly that you in a downside market, when you see the market go up, going against the market, then you shorted in that candle?
I did. If you look at the 5-minute chart, you see one big engulfing red bar.
Right here, yeah.
And I see, okay, this is, rather than enter at the bottom of this, I've waited to see if there's a little bit of a correction into, well, a little bit of a moving back into the bar, and I've got that, and I've entered there.
Now this is obviously probably was a very good entry, and okay, it really worked. But the thing is, this is actually trading on an area where you think the market will turn.
Well, having got that red bar, I think, okay, there's selling pressure there.
All right. Okay.
So instead of taking the entry at the bottom of that bar and with a big wide stop, I thought, okay, wait and see if you get.
Yeah, I understand.
And then I've taken it.
The only point I will make here is that if you enter a trade or you wait for a specific signal, normally people wait for the confirmation in early stages, of course, in the beginning of a movement. And this is, well, trading against the current, actually. Well, the current is down, that's correct, but against the wave which is going up, that's a risky position. But hold on. Yeah, I understand. Yeah, I understand it. Well done. You see, what and again, I'm referring to the online course. If you would just sign the channel, you see that it makes complete sense to enter on the lower end of the channel to trade it upside.
Yes.
You see that? So that's, yeah, well done. So always try to see this channel and the direction in which we are now.
Yeah, I have to say, very often I forget about it, but sometimes I don't. Sometimes I'm aware of it, although I might not have a line on it. I'm aware of it. The wider it goes, it's moving back to the trend line. Yeah, but I don't always think of it.
All right, okay. But here, the movement was definitely good. Well done. Yeah, I can understand the move. Yeah, it's good. That's very good. Excellent. Yeah, good trade. Well done. Yeah. The only thing I will say, and it's just with time charts, you do not control your risk because you don't know how far your stop will be, how much money that is. That's the only thing here, you see, because if you would have traded this with range bars, for example, instead of having a structure like this, one bar, and then maybe one other strong bar up, a triad would have given you this. which would in reality be 3 times smaller, meaning your risk would be substantially less.
Yeah.
That's
Okay.
the only reason why we do it.
Yeah.
Now, the movements you show me, Brian, are very good. I mean, it's obvious that you see the direction of the market, and your timing even is good. But the thing is, if you look at the nature of time candles,
Yeah.
and wanting to trade them on the short time, it's not that easy, because some of these charts are very small, but others are very big, and that's a problem for our business model.
Yes. And that was it. If we don't need to go back to the last chart, but that 5-minute candle down,
Yeah.
no, that was a big bar, and I'm thinking, yeah, the stop is much too wide there.
All right. Now I understand.
So, you know, as you say, the disadvantages to the time
Yeah.
aspect, it means that your risk is too big, or you've missed the move.
Yeah. It's a bit of a, you know, it's a bit of a, you know, because I'm always looking at the business model, and if I look at this, look there and there, this is, well, like 2.5 or 3 centimeters. It's an inch, right?
Right.
And I say, okay, if I want to make money, decent money here, I should maybe put my first target here, but hopefully be able to go and get, you know, a third or 3 times this. Now, the reason this is unlikely maybe is because this distance here is just too big.
Yeah.
If I can halve this here, my business model is substantially better. You understand?
Oh yeah. That is it. That is interesting.
And I'm just saying, Brian, the analysis and the way you look at it, and you see the direction, and everything you do, it's fine. But what you could do, for example, and that's something that I'm gonna make a note of that, because we'll do that next time. That is the 5-minute conversion to range bars or movement charts.
Right. Okay.
And I'll tell you why. Because let's say you say, all right, this 1 minute, that's all going too fast for me. I will tell you how we do this. We look at the 5-minute. You do your analysis on the 5-minute, as explained in the course. And you say, all right, let's say you are here. I would like to buy somewhere here. I would like to buy there. Now here, of course, this is already a big move, which we've missed. So how do you solve that problem? Well, what we do is we put in one indicator to see the speed of the instrument. What we do is we put on the ATR, the average true range. And let's say, for argument's sake, that the average true range on this Forex pair is, let's say, 12 pips in 5 minutes on average. That is the average volatility in 5 minutes. Okay?
Okay. Yeah. Right.
So that means that what the ATR does, what this, it's an indicator, right? But what it does, it calculates on a certain amount of candles how much movement is made. So, give you an example from experience.
Yeah.
If you look at the Nasdaq in the morning, the Nasdaq will move on average 10 to 15 ticks a minute. So it is. That's the speed. That is for them. If you go and watch in the afternoon at 4:30, you will have something like between 40 and even 80 ticks a minute.
Sounds more.
That,
A lot of speed.
that means the speed
Right.
is completely different. And that also means, and it's the same in Forex, if you would trade an instrument that is moving at what, let's say 15 pips per candle, and you put in your stop like here, and your stop would be, let's say, at 25, something like that.
Yeah.
But on a special day, something happens in the market or in the Forex pair. This ATR or average speed is not 15, but is 50.
Right.
Then your risk will not be 25, but it will be 75, give or take. Now, these 25, whatever, this might be $100 with which you can live, but this, my dear Brian, will be 300.
Yes.
And that might be too steep.
Right.
So knowing the volatility, the speed of an instrument is very important because it will show us how big the position will be when we trade this.
Right.
One of the reasons why I always try to convert people from time charts to trading on movement charts is because if I trade on movement charts, like you said, Renko, let's say you put in a Renko bar from 5 pips and another bar of 5 pips and another bar of 5 pips, you know that this distance is 10 pips.
Sure.
You enter here, you take another bar of 5 as a stop.
Right.
That's 15, that's another
Sure.
5, and let's say 2 with some slippage, that
Yep.
could be, and then you know my risk is 17 pips.
Right. And that stays a constant.
That stays a constant.
All right.
Then you know how much money you are playing with.
Right.
That I'm not, you don't have to do it, huh? But it's just
No, that
give
makes
you an
perfect
idea.
sense.
Yeah.
That makes perfect sense. The only thing is with the ATO, to find the speed of that, what value would you be using? I think if you open up the ATO, there's a standard setting of 13 or 14 or
Yeah,
something.
but I use 5. I use 5 bars, but not a lot because then I know more or less what the current volatility is.
Right. Okay.
And 5 is okay. It just moves around a little bit, but you just take an average, you take a view, and then you know. But so what I would normally do, to go back to our example, and that's how you could do it in the future. We'll just talk about it in the future. But
Yeah.
let's say you think this whole thing here in 1 minute and 5 minutes is too messy or too fast. And I understand that because it can be. And you like to trade Forex. Let's say instead of using the 5-minute chart, you use a 60-minute.
Yeah.
All right. You do your analysis on the 60 minutes. And in Forex, it makes a lot of sense. Why? Because the whole world looks at Forex in 60 minutes.
Yes. Yes. Yes.
But what conversion to movement charts will do for you is it will give you better entries and a precise money management. Now, how do we do that? Let's say on the 60 minutes, for argument's sake, the ATR is 25 pips. 25 pips. Now, what I will do, and you might have come across this in my videos, what I will do is I will take this value, divide it by 2.5 to 3. If I divide 25 by 2.5, I have 10.
Yeah.
So what do I do? I use Renko bars for 10 pips.
Of that size. Okay.
Yeah. So that's how I calculate the size of my bars. Now, if the next day, for one reason or another, the speed of the instrument is normally in real life is more or less always the same. It just varies a little bit, but it's not huge. But let's say on one day it is huge and the 25 becomes 80.
Oh, yeah.
Well, if you, for starters, you will see it and you say, whoa, that is steep. So you
Right.
might, take your position and divide it by 3 already. But then you'd have to use the 80 or
So you got
75, take it down
26
by
or
3.
27. Yeah.
Something like that. You could use an
Yeah.
average. You could use 25 also. It
Right.
doesn't have to
Okay.
be exact. But
Mhm.
that means that every bar would be 25.
Right.
Now that is substantially more because if you take another 25 here, that is 25, 25, 25, that's 75.
Right.
That means your risk is not 17, your risk is like 77.
Yes. Right.
And that's a difference.
It is. Yeah. It is. That's a different ball game. Yeah.
And what I'm trying to explain to you with this is that you understand what ball game you're in,
Yeah.
how much
Mhm.
money is on the table, right?
Mhm.
Now you can do it with time charts as well, but then you have to know, all right, where is my stop? And we're really the nasty bit is always you always see the movement when it is often too late.
Yeah. Yeah. Right.
It's real. Is reality. You can. It's easy to say afterwards. Oh yeah, look at this and how good it looks and this and that. Yeah, but in these time charts, you would have ended here, and that is too late.
Yeah.
You actually should have had a signal much earlier with your Renko or range bars,
Yeah.
and that would have given you a substantially better entry sooner, and also your stop wouldn't be that wide,
Right.
and that's a different game.
Yeah, it is. Yes, have a big advantage,
Yeah.
and it's difficult enough. So any advantage that you have, you need to use it.
So all right.
So
Anyway,
that would mean that I pull out the average true range indicator. I enter the value of, did you say 5 is what you're using?
I use 5 candles. I use
Right,
5 candles, and so I will give you a quick demonstration afterwards. We'll just go through
right,
your stuff here,
right.
and
Okay,
then I'll give you homework.
okay, okay.
Hold
Mm-hmm.
on. I won't just. What is this? Uh, where are you?
I got it.
All right, here it is. We were here somewhere.
Yeah. Oh, I think we had that. Yeah.
Well, we had that one, right? We had that one too. I'll go here. That's a nice one.
Yeah.
Now that's the one we did. That was the last one. All right.
All right. Okay. Mm-hmm.
We'll do this one.
That's choppy. Ooh.
Now, thing is, if you do the analysis, as I explained in the course, and let's say we do this on the 5-minute chart, then this is what you see. This and this.
Yeah.
That would mean, Brian, if I want to make money in this thing, in this movement, I have to get in somewhere in this area. So my stop has to be here. I have to go in here, and I should be able to make 2 or 3 times what I
Yeah.
risk.
Right.
Otherwise, it makes no sense.
Sure.
So we just trade when we can make more money than what we have to put on the table.
Yeah, right.
And here the advantage with, in fact, the disadvantage or the problem with this chart is your entry is good. But the thing is, if you enter on this candle there, and you have to enter here, and your stop is here, look at this.
And this is we're back to what we've just been talking about. The risk is too big.
You just can't,
Yeah.
even if you see it correctly.
Yeah.
All right.
Yeah.
Good. Now, also one thing is, the thing is, of course, not always, and this is a good point, is not always, of course, is this channel wide enough to make money. So let's say if your channel would have been like this, then this makes a lot of sense, because you have enough room to the upside to make enough money.
Yeah.
But if this channel is, as here, is rather thin, there's just not enough maneuvering space where you can see the money, where you can,
Yes,
you know,
yes.
at least, and then, you know, it's not at all a guarantee that it's going to go that way, but at least you can see it on the chart,
Sure.
right?
Sure.
Okay. So
Yep.
that's that. There's a little bit of the same here. It's okay. You see, look, if I sign this and this, if you go and get in here, it's okay. You know.
Yeah, but it's going back. We're going back to what you said right in the very beginning on the first part. You need to have that. It's in a band. You
Right.
need to clear it, and if it comes back in and it takes the new high, then go with it. Yeah.
Yeah. So that's the thing is, but the fact, the first thing you do is you see the control price here. And so if you're able to enter on this side of the market to the upside, then it's okay. Of course, here you have a fair value zone, which is not, you know, superb.
Right.
Okay. Also, and I have to say this, Brian, sometimes it looks messy. It is messy. Just stay out.
Yeah.
That you don't have an obligation to find the opportunity. Actually, it should practically jump at you and say, hey, you know,
invite me in.
Yeah. Right. And if it is, you know, messy and it doesn't look that well and it doesn't really move that much, or there's not enough room or this and that, just forget it. Move to the next thing.
Yeah, I think that's the thing with the time-based bars. You get drawn into it,
Right.
and it's really repeating and repeating. Whereas with the range, you don't have that.
Right.
It's much clearer.
I'm gonna give you an example in the forex market, right? And so you can see now. I just take let's say I use, well, I'll take the pound against the dollar.
Right.
Pound against the dollar. And I take, well, 240. I'll just, you take that out. See if I can throw this out. All right. Now I'll for our little example, I'll use 60 minutes. Okay.
Yeah.
That's a 60-minute chart.
Right.
Chart. Very simple. On any, you can do this on any trading platform. It exists on all platforms. You don't need NanoTrader for this. You can do this on all platforms. You just go in indicators, you go and get an indicator, and you take ATR,
Yeah.
you put it in,
Right.
and here it says five bars, which is good. It also has a filter in it, but you can, we don't need that. And so what I actually see here on the right, it also depends on the platform, but I can see here that if I draw this like this, I take an average, give or take. I know it's about 21, 22 pips.
Right.
Which I can see here. Yeah.
So that is saying to you, in the last 5 bars, it's moved in the last 5 1-hour bars as well.
Yeah.
Isn't that what it is? Yeah. It's
Yeah.
moving between 21 and 22 pips per
Something
hour.
like that. On
Right.
average.
Okay. I just wanted to be clear on what it is.
No, that's okay. And so what I'm saying now is, all right, I want to trade with this. But what am I going to do? I want to find better entries. And what am I going to do? First of all, I'm going to clean this up. And like this. I'm take this out. And I'm going to change this bar into a bar which has a volatility which is 2.5, 3 times smaller, which would be, instead of 21, would be 7.
Right.
And I'm going to trade with that one. So
Okay.
I'll look at the analysis on the 1 hour. And
Right.
let's say, for argument's sake, that we have a good possibility to trade in this area to the upside. All right.
Right.
Now I want to see this opportunity, but I want to see it. I will see it faster and preciser if I use movement bars. And this is how I do this. And it depends, of course, on which platform. Which platform do you use, Brian?
Well, I've been using the MT4 platform.
Right, that's okay. Well, you will probably find. But if let's say you have Renko on that,
which I'm getting from the C Trader.
Right, good.
And I'm looking at the C Trader, and okay.
If I let's say here, instead of 60, I say, look, I will use 5 first, and then I put this on Renko. Yeah. I have to put in here 7 or 8 pips. Now, if you have to know how to put this in the platform, but
that's how many the 7 comes behind how many zeros?
3 zeros.
So it's 0.0007.
Yes.
All right. Okay.
You see, like this.
Right. Okay.
Right.
Yeah.
Now I prefer range bars because they are a lot more precise. And I will get some ticks here. So I need to get better value here. And I'll put this on 6. It depends on the platform. It's not, but here you can see it, that all bars, give or take, have the same, hold on, I'll put it on ticks, have the same size. Hold on.
Yeah.
It is charging, because now it is a lot more precise. And you see, I don't know whether you can see this.
I can't see that yet.
Yeah. You see now.
Yeah.
And actually what you can do, I can actually put on the 60 minutes again underneath, right? And basically here, what you see, Brian, this yellow part here, what you see is actually the top side.
I don't know.
This is 60 minutes.
Yeah.
This is 60 minutes.
Yeah. Right. The bottom of this-
And this is the range bar, which actually has a volatility which is 3 times smaller.
Right. Wow.
I give you an example. If, for example, you would say, Wim, I would like to enter here. That would be pretty late, right?
Mm-hmm.
You actually would have gotten in this thing a lot sooner or a lot
Right.
better.
Right.
So this is something we will have to work on for the next time.
Okay.
So what I would like you to do now is you do the same thing as you did today,
Right.
but do it on range bars or Renko bars.
All right. Okay. I'll do that.
Do that. Yeah. The same
Yeah.
thing. You don't
Yeah.
have to do this conversion. That's too. We'll do that next time again. But you just take the Renko you like or the range bars you like. You get the charts, and when you think there's an opportunity, you make a screenshot of that.
Right. Okay.
Right.
Okay.
Again, when you got 20, 30 of these examples, send them to me. I will set up another meeting.
Right. Right. Okay. Fine.
Okay.
I'll do this exercise. Yeah.
Okay.
Okay. Then thank you,
Brian.
Wim, and have a good
Take
day.
care.
Yeah. You too.
Okay.
Bye.